Welcome to the latest episode of our podcast series for financial advisors. Today's episode is How to Set Up Your Business to Maximize Enterprise Value. It's a special industry update with Louis Diamond. I'm Jason Diamond, and this is the Diamond Podcast for Financial Advisors.
At Diamond Consultants, our mission is to help advisors live their best business life. We want every elite advisor to find exactly the right place for their business and their clients to thrive, whether it's at a wirehouse, a regional, boutique, or independent firm. As the industry's leading recruiters and consultants, we've transitioned more than $250 billion in assets under management in the past decade, and each year, 25% of transitioning advisors who manage $1 billion or more are our clients. If you'd like to talk, please feel free to give us a call at 908-879-1002. Are you a financial advisor who's curious about whether you're in the best place to serve clients, or if there might be a better way to optimize your business for the future? Should I Stay or Should I Go is a new book that serves as a self-guided journey, walking you through the key steps that Diamond Consultants takes with our advisor clients, whether considering change or not. Visit diamond-consultants.com/thebook to learn more.
All advisors, regardless of whether they are content where they are, considering a move, or are in the process of doing so, are forced to reconcile with questions like, how much is my book worth? How portable is my book? And how will this firm help me to increase the ultimate enterprise value of my business? No doubt, maximizing value is typically the goal of any advisor, regardless of whether they are pondering a move or not. And the reality is that movement is not, and should not be, a precursor to focusing on optimizing your enterprise value. So then what should an advisor who may not be considering change be thinking about? What we're really talking about are two distinct components of optimizing an advisor's business. Number one, the economics, the concept of maximizing your career enterprise value, or max CEV as we call it. And number two, setting up the business practices, logistical, operational, and otherwise, for success. I've asked Louis Diamond to explore this important topic with me in this episode. Our goal is to talk to advisors who may never make a move, or are perhaps 5 to 10 years away from doing so, and to offer advice on how they can best set themselves up for success in the short, medium, and long term. There's a lot to discuss, so let's jump right in. Louis, thanks so much for joining me. Welcome.
Of course, excited to talk about this topic.
Absolutely. Let's dive right in. So the first part, I want to frame this conversation through the dollars and cents or the financial side of this topic first. And just as a reminder, the topic we're exploring today is maximizing enterprise value, and looking at this through the lens of advisors who may or may not be considering change. But before we do that, let's just foundational concepts. Can you explain what we mean by maximizing enterprise value?
Yeah, certainly. So the definition of enterprise value is the summation of future expected cash flows, or put another way, it's the value that a business has at time of sale. So when we talk about maximizing that enterprise value, it's taking intentional actions to create optionality for the business so that even if you want to pass the business without cost to a family member, you want to sell internally, or you're looking to sell the business for the maximum value, that you're taking intentional actions to bolster the business's value. Basically, how much will someone pay for it at retirement or at time that you wish to transact the business?
Got it. And I know you've spoken in the past about this concept, and you've called it maximizing your career enterprise value. I know we've used the term max CEV before. Can you explain the inputs of that a little bit? Because I believe your max CEV model actually takes it a little bit beyond just the economics.
Yes, absolutely. So in traditional M&A, enterprise value, again, is the summation of future expected cash flows. So if you discount them, you come up with the valuation of the business. It's what someone, whether it's a private equity firm, a strategic buyer, will pay for the business at day's end. Our spin on it, the maximize your career enterprise value, is taking the summation of future cash flow concept, but breaking it into different components. The first component is ongoing payout from running the business. So I'm getting a 48% payout from my firm, and I'm expected to grow at this amount. So over the next few years, I expect that my cash flow from operating my business will be this. Or I'm going to go independent and my net payout will be 65%. So adding up the future cash flows of my independent business gets you that input. The second input would be proceeds from recruiting deals, whether that's a deal from a wirehouse, it's upfront capital from an independent firm. It's basically just a signing bonus or a forgivable note that a firm or a platform will use to incentivize you to move your business. And some advisors will make one well-timed move in their career. Some won't move at all. Some will move more than once. So looking at that component, because obviously it's real money and it is someone either in essence buying or renting your business or looking to have you commit to the firm for a period of time. So that's an important component as well. The third one would be what we call the happiness quotient or the best business life quotient. So this one does not have any sort of numeric value for a financial model. It's more so the concept that if I'm somewhere that I enjoy coming to work, I can serve my clients the way I want to, I'm able to grow the business without limitation, then that quotient is looking to be maximized. It's basically a nod to folks who know that they can get a higher payout elsewhere. They know they can get a really aggressive recruiting deal, but say, I'm really happy. And what's most important to me is stability. It's knowing it's the devil I know. And it's knowing that I can do pretty much my best work for clients. So not a financial input, but more of just a way to round out the concept. And then, of course, the final component, which is typically the largest one, would be the value for your business when you go to sell it. So it's the purchase price that a private equity sponsor will pay to buy all or a piece of the business. It's what your team might pay you through a sunset program at a major wirehouse. It's what an internal successor might pay you if you sell your business as an independent, or it's what a strategic buyer, whether it's a large national RIA firm, it's a bank, it's whoever it is, might pay for the business at day's end. So in totality, maximizing your career enterprise value means making intentional actions to think about how to get the highest score, the highest value across those four components.
Yeah, I love that. And in the second part of this episode, we're going to talk about what are those intentional actions that you can do to maximize this quotient. I want to first talk a little bit about the third component you listed, the best business life quotient or the happiness factor, because the thing that jumps out to me is you talk about recruiting deal being one of those inputs. And so that would suggest to me that if an advisor wants to maximize their career enterprise value, they really need to make at least one well-timed move, because otherwise you're going to put a zero in that recruiting deal placeholder when you could be putting 300% of revenue or 350% of revenue. And I think what you're saying is you use this happiness or best business life quotient as a way to reconcile that. An advisor might say, I know that economically I'm leaving some chips on the table, but my happiness and the stability of it is worth more to me. Is that a fair summary?
Yeah, that's exactly right. So even though to really get the highest score, the highest value in this formula, you're exactly right that really the way to do it is to make one or even multiple moves in your career. But we know that there's a ton of really savvy advisors who have incredible businesses, who really maximize their ongoing payout, who are building something that's very valuable if they want to sell it, but they enjoy having 30, 35 years length of service at their firm. So I think that's exactly right. It's not ours to judge what the maximum means to someone. For some, it's I make enough money where I can pay my mortgage, I can support my family, I have enough for charitable endeavors, and I can do good work from clients, and I get to work 20 hours a week. That might be someone's formula for maximizing their own career enterprise value. Someone else who, say, is more of a capitalist would say, I want the highest possible payout. I'm going to move every 10 years to get multiple deals. I'm going to build this thing with the intention of selling it for the highest possible bid. So I see successful advisors kind of straddle both sides of the fence. And it's really up to an advisor to decide how they want to live their business life and what's most important, maximizing the economic value or maximizing your happiness or your, balancing your lifestyle and all of the competing priorities that advisors have, whether it's family and country, religion, charitable endeavors, their team, et cetera.
Yeah. So let's talk now about the fourth factor here, because to your point, I think in terms of just pure dollars and cents, that ability to sell your business at day's end is often the most lucrative of those buckets. And it's certainly the most, I think, seminal moment because it's such a pivotal event in an advisor's career, right? The moment when you basically cash out your chips. I'm going to give you an example here. Let's say we've got two $10 million revenue producers, both wirehouse advisors, both same grid payouts. And let's also assume they define happiness and best business life the same way. But my two imaginary $10 million producers might actually achieve very different valuations on their business. Give me a little bit of context or color on why that is. What are some factors that make one business more or less attractive relative to another?
Yeah, so it's a really good question. So yeah, just because you're doing 10 million doesn't mean that you're going to have the same value as even a $6 or $7 million practice. The answer somewhat depends on who the buyer is. If the buyer is in essence another wirehouse firm, then the math is fairly formulaic. It's okay, you're a $10 million producer, you're going to get our most aggressive deal. Here's a certain amount of money that can go towards paying support staff, and your deal is going to be 300%, 350%, maybe a little bit more, about half up front, half on the back end. And then those firms will have their own version of a retirement plan. So basically monetize the business twice. But the rest of the makeup of the business, it matters. Like obviously, if the team is growing 20, 30% per year and it's run by 40-year-olds, a firm might be willing to get a little bit more creative around the edges. But the value is pretty much going to be the same across both of these $10 million businesses. Where it gets really interesting, and this is where some of the intentional actions really pay off, is if the buyer is a private equity sponsor or it's an RIA or someone who's really looking to buy a business as a business rather than, in essence, trade a forgivable note for an advisor to move their clients to their firm, then the things that really matter most to those buyers, the number one factor is what's the organic growth rate net of market appreciation. So there's studies out there that average organic growth in the industry is about 3 to 4%. Most advisors pretty much don't grow. They use the market to grow out of client withdrawals and losing clients. So firms or platforms that are able to grow 7, 8% a year on a compounded annual basis, they're definitely going to get a higher multiple and be on the higher end of a multiple range because the internal rate of return for a buyer is significantly better and the payback period is much shorter. So that's factor one. The second one I would say is what's the team dynamics? Is there next generation talent? So if the lead advisor is selling because he wants to retire in 2 years, are there servicing advisors or other partners who will still be around to service clients and grow the business? So a business that has, let's say it's one incredible advisor who's the rainmaker, he has a couple admin, doesn't really have a next generation, is going to get a very different value on their business than a $10 million producer who has two partners who are 40 years old. They have 3 servicing advisors. They have a paraplanner. And basically, if the G1 advisor is to retire out, the business is going to be totally fine. So that's factor 2. The third one I would say is just what's the makeup of the book of business? How many clients are there? What's the typical AUM per client? Usually firms want to see higher net worth. So let's say average client 1 to 10 million, or it's 10 to 20 million. They typically prefer that over a more mass affluent book. Doesn't mean those businesses don't have value, but typically the strategic buyers especially like the higher net worth businesses. It could also mean client concentration. Do you have one client that's 40% of the revenue? So if they decide to leave now or in the future, there's a lot of business risk there. And then I think other factors that are important, but probably don't weigh as much on valuation is what's the investment approach? Is this a proprietary single stock option business where the G1 advisor is just really good at picking NVIDIA and Apple and has this really specific strategy? Or is it more model based where it's more scalable? You can swap out who's managing the assets, or the assets can be centrally managed by a firm. So there's certainly other things, but please let me know if I missed any factors.
No, I think that's the right list. I think that one I would maybe add is fee-based percentage also seems to matter more and more. Is a more fee-based book seems to be more quality and more desirable. Let me ask you this though. It sounds like you use this formula, this concept, both in the traditional wirehouse W-2 world and also the independent space. But what I noticed you didn't mention, and probably because of how I asked the question, so if you talk about 2 top-line $10 million revenue advisors, we're talking about top-line revenue before expenses. But I would think that expense discipline matters a great deal when we talk about maximizing enterprise value. It seems to me that wirehouse advisors have been conditioned to maybe ignore it is not the right word, but they really focus on top line. What are your thoughts on this? Am I looking at this right? Do you think that expenses is something that wirehouse advisors need to do a better job of paying attention to in preparation for a move? Or is it something that you just shake out and figure it out once you're launching an independent business where you're more responsible for your own P&L?
That's a really good question. Yeah, thank you for flagging that, because when someone looks to sell a business, unless they're moving to another wirehouse, basically a firm whose valuation formula is we'll pay you X percentage of trailing 12 or of GDC or revenue, but any other buyer will look at. So basically, it doesn't matter what the multiplier is on EBITDA if the EBITDA is really low, obviously. And conversely, if the business runs lean and mean, you're going to get a much higher valuation regardless of what the multiple is. I think expense discipline is extremely important. It certainly matters less for advisors in a wirehouse because most of the P&L expenses like rent and marketing and technology and insurance are paid for by the firm. And typically based upon the amount of production a team does, they get a certain number of fully paid support staff. But all employee benefits, payroll, taxes, et cetera, are handled by the firm. So a team at a wirehouse, really the two cost items that they control, and I think it does matter to be mindful of it, is one, the team expense. So how many support staff, how many servicing advisors, how many warm bodies do we have? Because each additional person means a salary, it means a bonus, it means payroll taxes, it means more office space is needed, it means potentially needing to incentivize key people with equity. So that matters certainly more if someone's running an independent business than if someone's just going to go to a wirehouse, because they'll fit into kind of the formula that the wirehouse provides, and then they'll pay for any cost overruns on support staff, and it's not going to impact the deal. The other item they have control over is marketing. So how much am I spending on client events and on, let's say, other marketing initiatives? You don't have that many ways to market yourself, but it could be client travel if you're at a wirehouse. But I think those two things matters less if you're going to retire from a wirehouse or move to another wirehouse. But building the discipline around expense management leading up to a potential move to the independent space matters a great deal, because the number one driver of profitability for an RIA or really any wealth management business is human capital. So if you have the ability to run a fast growing business with less support staff and you can still serve clients while you still have capacity, then that business is going to be worth more. So building up we'll say the repetitions or building better business management practices matters a great deal if a team wants to break away in the future. And certainly if they're an independent business owner, they're always paying attention to expenses, because if they spend less, they get to make more. Or if they decide to invest in the company, invest in growth, they're going to make less, but presumably will grow faster in the future. So that's a very important concept, and it does matter for valuation.
Got it. Well said. All right, last question on the dollars and cents of this before we pivot to talking about some practical things advisors can do to better set up their businesses. So let's forget about, or let's strip out the best business life quotient or the happiness quotient for now. I want to ask this next question through purely an economic lens, a dollars and cents lens. An advisor has two paths, broadly speaking, assuming they want to make a change. One is, let's go to another traditional firm, take a recruiting deal. One is, let's go independent. Could both of those advisors conceivably maximize their enterprise value, or do you think one of those paths is the better or right way to do it?
Yeah, it's a really smart question. I would say, depending upon the circumstances, it's hard to say which path would yield a higher enterprise value. The reason is, if someone goes independent, they're going to get a higher score or a higher summation of future cash flows for the ongoing compensation bucket, because it's the difference between netting 60, 65, 70% of revenue versus 40, 45, 50% at a traditional wirehouse or W-2 firm. So obviously, independent advisor can make more in that case. The other thing is, on the deal side, many advisors who break away don't get any upfront capital. They're self-funding a move, or if they do get upfront capital, it's probably a third of what they can get from a competing wirehouse. So as far as the short-term recruiting deal, someone who's moving from a W-2 firm to another W-2 firm will max out the deal side, but it'll be a lower payout. The reason why I said it's really hard to say which one is going to be better from a financial standpoint for an advisor is if an advisor thinks they can transition more of their business going to a wirehouse because it's familiar, clients are comfortable with it. And let's say they think they can move 90% of the book to a wirehouse and only 80% to an independent. Even with the higher payout, the ongoing proceeds are going to start to look fairly similar. And the valuation will obviously be lower if less of the business comes over. The other key factor is growth rate. If an advisor thinks they can grow faster as an independent versus at a wirehouse because they can do all this interesting marketing, they can add additional services that can capture clients, they can offer more bespoke or out of the box private investments that might let them go more up market, then that's going to be better on the growth side. So there's a lot of factors at play, but certainly someone who goes independent is going to work for a good number of years, let's say 5 years or more. They can move over the book in a similar way as if they went to a wirehouse. Maybe they can grow a similar amount or faster, is probably going to be better off in the long term because the proceeds from running the business are more. But then most importantly, when they go to sell the business, independent firms tend to sell for more than an internal succession deal at a wirehouse. It's also at long-term capital gains versus ordinary income. And just depending upon the size of the business, the multiples in the independent space scale exponentially versus if you're selling the business within the wirehouse world, there's a formula, larger producers get more, but it caps out. So we've had examples of practices that we took from a wirehouse, they went independent for a couple of years. And when they sold, and to our question earlier, they did have expense discipline, they were growers, et cetera. They sold for 5 to 6 times their top line revenue, which would have been double or more what they could have gotten by trading the business to another wirehouse or selling internally. So I don't know if that answered the question or if there's more you want to add on.
No, that's absolutely perfect. The way I think about this is we've worked with some of the most money-driven, capitalistic advisors out there who have looked right up until the last minute at both independent and traditional firms. And they just wouldn't do that if they didn't think that both of them conceivably had a path towards maximizing enterprise value. So totally agree with your premise there. I want to pivot though. Let's shift gears and talk a little bit about the nuts and bolts. So I'm an advisor today. I don't want to make a transition necessarily. And I know there are things I can be doing though, even though I may be 5, 10, or infinity years away from a transition to better set my business up for success, even if it means staying put. So I assume that sort of has an impact on the above, right? If you set up your business well today, that should translate to a higher enterprise value down the road. Is that a fair statement?
Yeah, I think that's right. I don't know who said it. It was some famous author or college professor said, build your business today like you're going to sell it tomorrow. And I think that's the exact right way to go about it. Because even if you're never going to sell it, or you're just going to pass the keys on to your kid, or you don't care about the money, it builds a better business. If you're making decisions based on if a third party came in to evaluate the business, the strengths, the weaknesses, et cetera, what can I do to mitigate the weaknesses and enhance my strengths? So worst case that happens is if you do this, you're running a more efficient business, you're running a business that probably grows faster, you're running a business that's more portable and creates optionality. So yeah, I think it doesn't matter if you're 20 years away from retirement and you're not even thinking about selling, or you're just going to retire from your firm, or you are planning to sell it to the highest bidder in the independent space. Taking intentional actions to maximize enterprise value, as long as it's good natured and you're not cutting your whole team to bolster the EBITDA. You're not growing for growth's sake and adding all these clients that don't fit. I think if you focus on the rest of it, the factors we said before, organic growth, expense discipline, fee-based versus commission-based, investment approach, next-gen team, all you're going to do is build a better business. And you create the option for yourself to sell it to the highest bidder, sell internally for a discount, not sell for anything, or essentially die at your desk and just keep working until it's no longer able to.
Yeah. All right. I like that. So, and I don't need specific examples here in terms of go fire your entire support staff tomorrow, but can you rattle off a couple of tangible things advisors can do to optimize their business, let's say years before a move? Some day-to-day type of stuff.
Yeah. I'll bucket it into 2 different lists. The first one would be just actions that any good business can take leading up to a transition or leading up to an eventual sale. The second one is going to be more tactical items that a business that is going to transition in the future can take to basically make the business more portable. So the first list, we mentioned some of the factors, but it would be really focusing on the growth of the business. So not just I returned 12% in my stock strategy this year versus 8% for the S&P 500, but how many net new clients are we bringing in? How much AUM from existing clients are we bringing in? And creating, we'll say, programs or strategies to make it systematized, whether it's across the advisors on the team or across the business. That's critically important. Another one would be basically how efficiently does the business run? So all of our processes. So we bring in a new client. Is it streamlined that Joe does this, Phil does that, Mary does this? And we have it dialed in that when a client comes in for a meeting, we have all these different things that happen. They ACAT their accounts over, we put them into a model, and we're good to go. Or is it pretty much all hands on deck and mass chaos where it's not really organized? You're not using technology efficiently to build out the process. Everyone's getting a different portfolio, and it takes way more time to add folks and to service them. That's another one. I think a third one would be developing the team members, whether it's using the training programs from the major firms or hiring folks out of college and being able to train them, or elevating key support staff into advisor roles, basically building the next generation team so that if you want to retire in the future or you want to offload your B and C clients, you have credible folks who can keep the clients and serve them really well. So I think that those would be more of like the business strategies that someone can use, but more of the tactics around an actual transition or leading up to a transition would be things like if all else is equal for the client, is using evergreen private equity or basically forming direct relationships with alternative investment managers rather than going into feeder funds, because feeders tend to not be portable. Again, got to do what's best for the client. But if you're building the business to create options open, even if you don't move, and you view the B-REIT as similar as some feeder fund for real estate, use B-REIT because B-REIT tends to be portable, as an example. A second one would be, I like this strategy, and we have a tool that we'll make available on our download page, but is to get really good with creating a digital footprint for your clients. So using your firm's virtual vault, uploading financial plans, statements, trust documents, tax returns, pretty much all their financial information that just helps the client because you're organizing them. If something happens, family members can access it. But the benefit is typically you can't take data with you if you make a transition, depending upon what firm you're at. So if this data is out there, you can't take it. But if you move to a new firm, you can instruct the client once you move and they've agreed to come with you of how to basically download or assign permissions to you to access those documents. So I think that's a great one. Just again, building a better business, but helps with the transition as well. And then I think the third one that I'll mention, we have probably a list of 10 that run in a similar fashion, is really making sure that years leading up to a transition, you're just showing up in better and more impactful ways with clients. So being much better if the market's down 5% or 2% in a day, that you're more intentional with calling every client, even if in the past you didn't. Making sure you're doing the in-person review meetings if maybe you migrated to virtual. Make sure you're calling to wish them a happy anniversary. Basically the little things that advisors sometimes don't do or take for granted. All that stuff makes a big difference in cementing the relationship and ultimately demonstrating your value so that if you do want to make a transition in the future, it's an obvious decision for the client. It's, yeah, you're instrumental, you're amazing, we love you, versus why are you doing this? It seems like a pain to move and it's been mediocre. I may as well give Joe, who's offering me free fees for a year, a chance.
Yeah, no, I love it. And it's a good point. We also, I think, have a tool on this max CEV concept. We'll make both tools available. And at the end of the episode, we'll walk through how to access them. It feels to me the one area where we hear most commonly around setting up your business in advance or positioning your business to optimize portability is around investments. I wonder though, and I know you've caveated this with all of your comments around you have to do right by the client, but to me, like there's two issues that come up with these strategies. Number one is doing right by the client. So it's easy to say, put your clients in an ETF if that's just the same as putting them in an alternative. But if that's not the case, I think that's a hard concept to reconcile. And then the other one is, doesn't doing these things in and of themselves raise some alarm bells? Like if all of a sudden you start using the digital vault or start transitioning your assets from SMAs to ETFs that are more portable, does that not tattle on yourself that this is something you're considering?
It certainly could. With some of the items I shared, they're all things that are just going to be value adds to clients, right? Like creating a digital vault, there's no downside to the client. So certainly if in the same month or same quarter, you start converting your entire book to liquid ETFs or to stocks, or you move all to cash, From a compliance standpoint, that probably is a more obvious contender to raise alarm bells. Same thing, if all of a sudden everyone's using the virtual vault, it could raise alarm bells. But I think it's more just about, hey, we just learned that this tool is available. Clients have been asking for it. We've just been too busy to implement it. So now our team goal is just to digitize our client's life. So I think depending upon the tactic, there's more or less risk involved. And I think if you have some runway before you want to make a transition, spread out the activities. And if there's 5 tactics on our list that you want to employ, don't do all of them this week or this month or this quarter, but spread them out. Pick 1 or 2 and just do it in a way that if someone was looking at you, that it was defensible. It wasn't just a jerk reaction that's going to raise the alarm bells of compliance or your manager or other folks within the firm.
Mm-hmm. Yeah. You remind me of a good quote. I think it was one of our podcast guests. I can't remember exactly who said it, but the concept of digging your well before you're thirsty, or really just being proactive and strategic about basically everything you do in or around your business. Look, I think at the end of the day, the narrative you are telling is one that should make a lot of sense to advisors. It's not so much in the best case scenario, do I need my digital vault? The hope is hopefully not. But you have to think about this as you want to have as few hooks in you as possible so that in the event you either need a plan B, you need to do something quickly, any number of things that could happen, you are better prepared to do so. I can't tell you, and I know you would say the same, how many times we see advisors just caught flat-footed. And it's frustrating, honestly, and it's frankly a little sad because there's things they could have done or should be doing to avoid a lot of that pain down the road. And I think that's what we're talking about here. It's not so much if you don't use a digital vault or if you have clients and SMAs, you're a bad guy or you're running a bad business. It's more as you're thinking about the future, can you credibly tell yourself and your clients, we are doing everything possible to make this team as good and as productive as possible? Is that a good summation?
I think that's exactly right. I don't equate building a business that is portable. So you don't have proprietary products. You're not really using the banking services of the firm. You're not using alternatives. You digitize everything. Like you have a small number of client households. Again, I think these, even if you don't intend on moving, it just creates a better business. A portable business is also typically equal to a simpler business and one that someone else can pick up and manage if you transition it, or one that if you either have to move because of a compliance reason or a policy change, or because proactively you want to do something different, that you have that option for yourself.
Yeah. And what do you think is the risk of not doing these things? So one obvious one would be it potentially impacts your enterprise value, right? I think that's the tie-in from our first topic here is that if you don't do these things, it's possible another firm sees you and says, this book is less portable, so we'll discount deal. Am I thinking about this the right way?
Yeah. The risk of not doing what will make it more global to the whole episode is obviously your business is going to be worth less at day's end, which no one wants. Even if you're not going to sell it, I think it's most advisors' goals to build the most valuable business possible. So that's one. Certainly all these tactics help you sell the business for more in the future. I think the other thing it does is you're not running as clean of a business or as good of a business. So if you take these actions and you're intentional about how to maximize the value, like we talked about, your growth will likely be better. You're likely going to have a more well-rounded team. The business will be simpler. So yeah, I think that the risk is certainly financial, but also just as far as running the best possible business or not.
Totally agree. And I would actually caveat the advice I think you've given. I actually think it's particularly relevant for people who have been in one place for a long time who may never make a move. Because for better or worse, I think due diligence or considering a move and certainly making a move forces you to reconcile a lot of these questions or a lot of these decisions. Whereas it's very easy to get caught in kind of status quo mode or inertia mode if you're a lifer, right? I've been one firm for 25 years, no intention of ever making a change. Why do I need to undergo these actions? So that's one interesting comment here is I think some people who have gone through due diligence by default do some of this stuff. Do you agree with that?
Yeah, I think that's right. Because they start looking around. Let's say my firm offers a 0-fee SMA. Awesome. It's great while I'm at the firm. But looking out across other firms, that doesn't really exist. So just being mindful of the fact that this is a benefit of my firm. One, it may lead you to stay because that's really important to you and it's good for clients, but it also may help open your eyes to the fact that this isn't going to last if we decide to move. So maybe going forward, we'll try to reposition or rebalance portfolios into BlackRock and into Vanguard and into managers that charge a fee rather than the internal strategies that don't have a fee, as an example. So yes, I think for a lot of reasons, it just helps shine a light on the business Basically, when you're doing due diligence, most of the work is on the other firms or platforms to prove to you that it's better and that they're better than the other 6 firms you might be looking at. But you also have to explain your business to firms. You have to explain the makeup of your book. You have to map over the book to different platforms. So all of it just makes you, I think, more mindful and a little bit more tuned in to how the business works, which even if you don't move, I think is only a positive.
This has been great. I don't know if you have any other final advice or comments, certainly welcome to share. My takeaway here is maximizing enterprise value is obviously everybody's goal. And it's important to understand the definition and what it means to maximize enterprise value. That's step one. But then there's also, what are you doing to better lead you to the promised land of actually maximizing your enterprise value? Right. 2, I think, really important concepts: how to maximize your enterprise value. And then what are things people can do today, years in advance of a move, or even if folks who would never make a move, to just best set up their business for success.
That's exactly right. Yeah. And a lot of these concepts will make tools that we've created available on the episode page. So we have a one-pager that dives into the different components of maximizing your career enterprise value and some of the strategies you can take to either think through the different categories or to maximize those areas. And then we also have our top portability tips tool, which is 10 or so tactics we got from interviewing over 100 different teams that we've worked with and asking them the question, if you had hindsight and 3 to 5 years before making a move, you did XYZ things, what would you do? And it's a summary document from those interviews. So I think both would be really valuable if you plan on moving, you're in process of making a change, or you're just thinking of how to run the best possible business and are never going to move.
Absolutely. Well, thank you so much for joining me. I'm excited to revisit this topic. It's such an important and substantive topic, but really appreciate your time and expertise, Louis.
You got it.
As a financial advisor, you hold yourself to the highest standards of integrity, honesty, and credibility. You are successful because you take your professional responsibilities seriously and are dedicated to your clients. But are you living your best business life? Are your goals aligned with your firm's, or could a better option exist? Should I Stay or Should I Go is a book written with you in mind. It's a self-guided journey that walks you through the key steps that we take with our advisor clients. This strategic thought process and roadmap to professional self-discovery is designed to help you ask the right questions and think critically and objectively, whether you're considering change or not. Learn how to get your copy at diamond-consultants.com/thebook.